We know where investors are looking right now, at least in the U.S. They're looking at U.S. telcos, they're looking at utilities, and they're looking at some big pharma here that pay some fat dividend yields. But here we want to talk about a strategy that actually looks to kind of supersize that yield. And let's look at a stock like Verizon, which is deemed to be pretty defensive here. It's got a 4.3% dividend yield. And let me just give you a few reasons why you might look to sell strangles if you are long Verizon stock that you're already there because of the defensive nature and because of that dividend yield. I mean, one of the reasons here is you're there because of that defensive nature. And we're going to get to what selling a strangle is, but one of the other things that you want to think about is let's do it in a stock that's kind of range bound, that you don't think is gappy one way or another, because we're going to be selling options against your long stock. And the last part about this, we've talked about overwriting. That's just selling a call against your long stock. We're also going to be selling a put. You want to do this in a stock where you're willing to buy more. So let's look at the chart right here. This, to me, we've had this recent move here as Treasury yields have come in the U.S. over the last few weeks. The stock's moved up. But if you look here, there's a pretty well-defined range. This was the breakout level about 48, and it kind of got rejected up here at 54. That's what I'm going to use for the range bound. And so what am I doing here to add yield to Verizon? I would look out to August expiration. I would think about selling the August 48.55 strangle. That would be selling against 100 shares, one of the August 55 calls at about 40 cents, and selling one of the August 48 puts at 45 cents. I'm taking in 85 cents in premium here. And what that really does, it sets up an 85-cent buffer to the downside, but it also gives me an added yield in between the short strikes while I'm also long the stock. So I can make money right here up to $55. On August expiration, my stock would be called away, but that would really be at $55.85 if you add back the premium that I received. That's up about 6% over 2 months. That's a pretty reasonable annualized yield, especially when you consider what that dividend yield. And then on the downside, it gives me a buffer from 52.75 down to 51.95. And the worst case scenario is the stock is down 9% at 48, and against one contract, I would be put another 100 shares of stock. That's down 9% from current levels. But remember, you have that dividend yield. You took in some of that premium from the strangle sale. So this is a strategy that if you're comfortable owning a stock, and if you did this routinely, you could actually really supersize that dividend yield, and it would annualize to something far greater than that dividend yield.
I think that a lot of people out there are probably watching this strategy and thinking this is something that I should consider, because everybody has been flocking into these yield stocks. They are trading at a premium to the S&P 500, and so they don't know where they go from here, but they want to hold on and be in defense.
You know, take a look at the strike of the put that he's selling at the 48 level, collecting 85 cents. Basically, if you are put the stock, you're going to own it at 47.15, which is just a hair above actually the level at which it was trading before it sort of broke out in January. This is actually a really smart investment strategy, and it's one that a lot of very sophisticated long-term investors systematically use. Leon Cooperman at Omega is a good example of that, former head of Goldman Sachs Asset Management. So this is a good, smart trade, I think.
And a nice yield for what it's worth in a yield-less environment, right?
Exactly.
And it's good for, I mean, as the bond yields go lower and looks that way, this just makes us even more attractive.